Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Hello, and welcome back to another episode of the AAA Storage Podcast. I have with me, as always, Paul Bennett. Hey, Paul, how are you?
I'm good, Brian.
It's good to see you, man. So last week we talked about a kind of like a wisdom perspective on how you see things given your decades of experience in the real estate market. And this week, I want to talk a lot more about the data, the quantitative picture of where we find ourselves in the real estate market. And this is kind of a mid-year update in 2025. And it seems that the data indicates we're somewhat at a bottom in the real estate cycle. I know there's a lot of nuance to that, which we'll get into, and different markets are experiencing that in different ways. And of course, disclaimer, we cannot predict the future. We humans are very limited in that way, and we're very bad at it. But seeing what we can see in the data, there is some indication that this may be a bottoming period, which means this is a really great time to consider getting into real estate. Kind of self-serving, giving the podcast and giving the sponsor here. But Paul, I want to hear from you. What data are you seeing in these different markets that you've analyzed? I know you've been poring over some notes. What are you seeing, and what can you tell us about these different markets and how you're thinking things are playing out as we're in the middle of 2025?
Yeah, Brandon, it's really an interesting time. As I looked at data over the last day or two, in preparation for this conversation, and I do have some notes in front of me. I don't normally, but there's a lot of numbers and a lot of data, and I was afraid I would forget some of it. So, but a couple things came clear. Number one is I think every sector is at a little bit different stage in the bottoming process, and we talked about that for the last couple of episodes in different ways. But it's also very interesting to me as I looked at all the data and thought about the fact that we sit here today in May of 2025, almost June, almost exactly within 2 months of the onset of the pandemic and the lockdowns. And as you look across the sectors, even though they're in different places and you have different dynamics going on, all of where they are today, each one for its own reasons, is tied to the impact of COVID-19 and the pandemic and the shutdown in 2020 and everything that happened after that. So it's really an interesting look. But yeah, I think it's fair to say that in most sectors we're seeing either the beginning of a bottoming process or even late stages in some of the sectors of a bottoming process.
Interesting. Okay, interesting. So I know, every market's different. We talked a lot about the different, asset classes and even hyper-local markets and how you guys think about geographic regions and things like that. So where should we start? Where's like the entry point to all this data? Is it a particular asset class or a region? How do you think about it?
Yeah, I think let's talk about asset class. I think that's a good way to organize the thought, and we've talked a lot about multifamily, over the last few weeks, so we can kind of start with that one. As I looked at the data for each sector, a theme emerged, and I would say the theme for multifamily is gathering momentum. If you look at multifamily, it was subject to a pretty traditional, predictable dynamic. When COVID hit, there was some mobility. People wanted to get out of the major cities in the Northeast and get to the Southeast, in the Sunshine Belt, as it's called. And that combined with demographic trends and low interest rates caused a tremendous amount of development. That all came home to roost in late 22, 23. And you saw rent declines. You saw projects struggle to lease up because there was an oversupply in the market. And there were some real headwinds. There were some investments that didn't turn out very well that were made in that 2020, 21, 22 timeframe. What you see in the market now is, for example, rent growth is positive and just only slightly below the long-term average. The long-term average is about 2.6% rent growth on average across the country, about 2.2%, today. You've got vacancy up slightly in some markets, up about 2% overall to about 6.2%. But you've also got a dramatic decline in new construction. New construction in the multifamily industry is at a 10-year low right now. So what you see is it transitioning from a market that was out of balance in supply and demand to a market that's coming into balance. And I don't think you'll see the kind of rent growth that you saw, in that 21, 22 period, early coming out of the pandemic, where there were markets where rent growth was 6 or 7% year over year. I don't think that's a normal state. I think it was kind of driven by the pandemic and some of the effects of the pandemic. But I think you'll see it, settle back in. And if you I looked at about 4 different projections from CBRE, one of the major real estate firms in the country, Freddie Mac, Fannie Mae, and JP Morgan. And what you see is all of them are predicting rent growth this year in the 2 to 2.5% range. JP Morgan's a little bit above that at 2.7%. And all of them are predicting vacancy rates right around the 6% range. And feel like vacancies may peak a little bit later this year, but only a matter of a handful of basis points above where they are today, and then really stabilize. So you've got pretty good fundamentals shaping up in the multifamily space. And cap rates today are in the 5.5 to 5.75 range. They've crept up about 30 basis points in the last few months, but seem to be fairly stable. And that's on the high end. I mean, during the heat of the market, we saw cap rates sub 4. And so, that's a crazy number in terms of the value of these properties. It's come back into a much more reasonable range now. Sub 6, but not way down in the low 5. So I think you've seen net absorption go up by 46%. You're seeing rent growth stabilize. You're seeing occupancy fairly stable. I think it's a clear picture that multifamily is sort of in the middle of that bottoming process. And I think the only negative in multifamily is that you're still seeing negative leverage. You're still seeing interest rates that are higher than the cap rates. And if interest rates will moderate a little bit more in the last half of 2025, which is at least a possibility, I think you'll see that one negative go away and the market really start to get traction. So maybe a little tough time to develop multifamily, but certainly not a horrible time to acquire existing properties.
Cool. Interesting. Okay. That's helpful. So the theme with multifamily is gathering momentum. See to be maybe at the center of this bottoming period, possibly on its way up from an investor's perspective, which is good.
Yeah, there's an outlier out there that I can't really predict, and now I'm just going to confuse people. But obviously the multifamily sector is tied to the residential housing market.
Okay.
And today it's about $1,120 a month cheaper to rent based on average rent rates for a 2-bedroom apartment than it is to buy a house. That's a pretty big spread. But what you're starting to see in the housing market is you're starting to see some signs of weakness. Listings are way up, inventory's up, prices are beginning to soften a little bit. I think somewhere in the neighborhood of 20% of all sellers were willing to make a price concession to get the property sold. So one of the things that's driven a lot of the demand over the last 5 years for multifamily has been the cost of housing and the cost of money, the cost of mortgages. If those moderate a little bit, it may take a little bit of the wind out of multifamily sales, but I don't think it's significant enough to change the prognosis that it looks like it's really beginning to gather momentum.
Yeah. Okay. So is some of that complication also due to correct me if I'm wrong, but the long dated maturities, long end of the curve for bond markets is still pretty elevated, even though people thought maybe it was going to come down a bit in this first half of the year, but it's still around 5%, I think, on the 30-year or 10-year or something like that. So is that kind of projecting, like pushing out that, I guess the positive outlook?
Yeah,
that's the way I could say it.
Particularly in the housing market, where you saw rates get down a little bit into the mid-range 6s. and you've seen them tick back up to around 7, a little bit over. What the housing market is telling you is 7% is too much. You see buying activity decline and inventories build every time rates get around 7%. So, and unless we get some rate relief, you're going to see downward pressure on residential housing values, which may open up that market to some people who are prospective renters today, if that makes sense.
Yeah. Okay. Interesting. That's helpful to know that threshold of 7% is something to look for, at least on the mortgage rates. Interesting. Okay. Okay. What's the next asset class and theme you got going on?
I'm going to skip around a little bit. This one I won't talk about in great detail, but it's actually one of my favorites, retail. And the theme for retail is stability. What you saw was some short-term pressure, during the pandemic itself, when certain types of retail locations were shut down and, people weren't going in there. But the ones that survived that have done pretty well, and retail real estate's returned to normal fairly quickly. The first pressure that it faced was all the buzz about all the online purchases that people were making, and how that was sucking the wind out of retail. And it did. It still has a real profound effect on mall properties and department stores. But the retail that I like more than any is grocery-anchored shopping centers. Because although you can buy groceries online, 95% of all people still want to go in the grocery store and go grocery shopping. And grocery-anchored shopping centers have all of the neighborhood services that you can't get online. It's got your State Farm agent, it's got the nail place, it's got the pediatric dentist, it's got the veterinarian, it's got all the services. So a well-located grocery-anchored shopping center, to me, has been and continues to be a great part of the real estate world. Consistent demand, low vacancies. And interestingly enough, as I looked at some data, institutional investment in grocery-anchored shopping centers is up 400% from the first quarter of 2024. You've got some real serious money that is looking at that grocery-anchored space and likes what it sees and has been deploying capital, fairly aggressively. Lease volume growth, which is another statistic that you look at, is going to be somewhat limited, but it's somewhat limited because it's constrained by supply. The problem is you can't lease up a lot of stuff because there's not a lot of stuff to lease up, if that makes sense. So the rent volume numbers are sort of flattening out, but that's really because there's so little supply in the market, there's so much demand. That there's just not room for a lot of new lease volume. But you're seeing markets in some cases that are seeing as much as 6% rent growth in the retail space. And again, retail's broader than just grocery-anchored shopping centers. The general retail space, all these dynamics apply, but they're probably especially pertinent to the grocery-anchored space in retail, which is, again, I've owned several grocery-anchored shopping centers over the years and just developed one outside Charlotte, North Carolina in the last few years. And I'll tell you, it's an interesting thing, and we'll get off this one because this is a sort of an offshoot category. But we had the development I've talked about before. We bought the land in 2006, and we had a site plan. We battled through a zoning battle that took forever after we had to hold the property forever, and ultimately had a site plan that we thought would work. But we were having a little bit of initial trouble leasing up some of the other retail space in this mixed-use development. It was 160 apartments, and we had a daycare planned on the site, and then about 100,000 square feet of retail. Along the way, we were approached by a grocer in the Charlotte market, Harris Teeter, and they moved too slowly, but that sparked us to talk to another grocer, Lowe's Foods, in the market. They very quickly loved the site. President visited, signed a lease, and that grocery anchor transformed that entire project.
Wow.
We leased up the rest of the commercial space in record time because of the rooftops that surrounded that property and because of the value of a grocer tenant in that mixed-use development. it really flipped it on its head. And now even the people that fought us in the zone, there's a neighborhood adjacent to the property that really, really battled hard in the zoning battle. The convenience of being able to never leave their neighborhood. Our development is connected to their neighborhood by a road. They can never leave the development and go to the grocery store, stop and get stuff at other retail locations, and be back home in 5 minutes. They absolutely love the project, but it was a battle to get there. So anyway.
That's huge. That's huge. It's interesting that it takes that one thing, that if you can get that anchor, it flips everything. And I totally get it. I live in kind of a food desert where everything else is walkable except for a grocery store. And I really wish there was a grocery store right here.
Yeah. Anyway,
Cool,
but it's retail. The theme for retail is stability. It has been fairly solid, in more recent over the last 2 or 3 years, and remains so. And particularly the grocery anchored space, is seeing a lot of inflows of capital. So really good values there, and it's just a product that won't be replaced. And so I think it's an excellent area to look. The next sector up is industrial. And I would say the theme for it is it's fundamentally sound. You've got two parts of the industrial space in the terms of how we think about it. One is the general industrial space, which is really 100,000 square foot properties and up. And that space had its own COVID impact. COVID drove a lot more online purchases and caused companies to really rethink their supply chains and their logistics. And so there was a tremendous amount of demand for general industrial space coming out of COVID. Low rates fueled everything that we're talking about in that time frame. When you saw, when you could go borrow money at 3%, every deal was easier to pencil. And so the importance of logistics and supply chains and the shifts caused by COVID, combined with the lower interest rates, caused a little bit of oversupply in the general industrial space. So it had its sort of hiccup in 2023, rolling into 2024, but you're now seeing that balance out a little bit. Development has slowed, and we're really getting back to the pre-pandemic sort of balance between supply and demand. So general industrial is stabilizing with vacancy rates in the 7 to 8% range, which is a fairly low number. I'd rather see it around 95, around 4 to 5%, but still not way off where you'd like to see it. The small bay industrial, which is the product we build, continues to be extraordinarily strong. I would tell you that it's ultra tight in most local markets. National vacancy is around 3%, so 400 basis points lower than the general industrial category. And it's interesting. I was trying to look at data and get a feel for why there was such a supply problem in that small bay industrial product. And part of the answer is developers like to do bigger projects.
Okay, tell me more.
It's just a matter of efficiency. If I can build 1 million square feet and lease it, that's in one project. That's easier than building. Our typical small bay business park will run 100,000 square feet. So I'd have to find 10 pieces of land, get it zoned 10 times, and construct 10 separate projects to get to 1 million square feet. So I think there's a little bit of that. It was just an interesting comment I read in doing a little bit of research. But overall, the industrial category is kind of returned to sound fundamentals, and the small bay space continues to just be as hot as a $2 pistol in most markets. It literally, in Las Vegas, there is zero availability, just one market to pick on. And like you said, with a 3% vacancy nationwide, it's a product, and it's the people we've talked about before. It's local and regional service providers. It's last mile logistics. It's internet-based businesses. It's light manufacturing. And now there's even a trend, although we haven't really gotten involved in it, of sort of man cave uses for these industrial spaces. Guys that want to put their cars and their toys and maybe create a living room environment and sort of have a place to get away to. Several people have talked to me about it. I hadn't been able to wrap my head around that, but apparently it's a use that's becoming more common in that small bay industrial space. So
Interesting. I feel like this is something you should follow that rabbit trail and see what's up with that, because that's kind of a fascinating factoid. Interesting. Yeah. And you've mentioned before, I think, too, of like batting cages. Is that something you've talked about before?
Yeah, that's
too?
what I was just
Things
getting
like
ready to say. After building this product since 2011, and almost all of our tenants being the people I've already described, local regional service providers, HVAC contractors, plumbing contractors, car repair, providers, last mile logistics, all that. In the last year, we have seen more retail or consumer-facing uses for the space. The explosion of pickleball is a sport, and it's the fastest growing sport in America. We have 2 of our 20,000 square foot buildings that we would typically divide into 3,000 square foot bays and have multiple tenants in. We've leased the entire building to a pickleball operator and finished it out as a private pickleball club with a mezzanine up top and a restaurant and a bar and 9 indoor pickleball courts on the bottom. We've also seen the batting cage. We have 2 facilities we've leased to batting cage operators that want 15 to 20,000 square feet at a pop, where they have batting cages, and they often have a workout sort of area because they're training with these younger athletes, and so they're lifting weights and doing drills and that type of thing, in addition to just hitting baseballs. And so anyway, it's been some very unique uses for that space. So it's called flex space. It's super flexible. That's one of the reasons why it's in such demand in almost every market in the country.
Yeah, I was going to say it's almost like the confluence of many different trends. If you say the rise, the internet businesses, if you will, over the last couple of years, there's an increase in entrepreneurship in general, which has fueled, I'm sure, a lot of this. But also the logistics, the e-commerce thing. People need little warehouses and fulfillment centers, things like that. And then you get this consumer demand, if you will, the man caves, the batting cages, the pickleball courts.
Yeah,
I think it's fascinating. Yeah.
And people who, I think people who aren't in the business think about self-storage and they picture somebody like you or me moving our stuff into a self-storage unit. The reality is every one of our self-storage facilities has a pretty significant business customer base. Where businesses are keeping inventory in a self-storage facility, or if they're a landscaper, they're actually running their business out of a self-storage. They keep fertilizer and lawnmowers and stuff like that in the self-service. And so, which is why we build self-storage and office industrial flex or small bay industrial side by side, because there's actually some synergism. You get a customer in the self-storage facility that his business begins to grow, he needs more space. He can literally move on the other side of the fence into one of our office industrial flex bays. And we wound up with flex customers who need even more, warehouse space, and they've got in the 2,000 square feet they've got behind their 1,000 square feet of office, and they rent a storage facility. So there actually is some synergy between the two that wouldn't really be obvious unless you're kind of in the business.
Yeah, that makes sense. I have a friend who runs a jewelry business and is getting out of his house because of so much inventory. He's going to put that in some self-storage kind of flex space. Yeah. So yeah, it makes sense. I love that. Okay, so we've got multifamilies gathering momentum, retail is a point of stability, and industrial is fundamentally sound. What's next?
Office. Continued challenges.
A sour point in yes.
And I haven't done a great job of stringing it together, but where each of these markets is today is directly related to dynamics that were created as a result of COVID. None is more directly correlated to what happened in COVID than office. And it's obvious, right? The technology was already there, but the lockdowns during COVID it just caused an explosion in the remote work world. And people have been very hesitant to go back to the office, so to speak. Right now, the expectation is that vacancy in the office market will peak in 2025 at about 19%. That's a pretty significant, vacancy rate. And I said 2025. It's actually going to peak during the year 2025 at 19%. The data shows that it will continue to climb and actually finally peak and maybe start down in 2026. There's a lot of pressure on older Class B and Class C properties. The Class A properties in core markets like Los Angeles, New York, Dallas, Fort Worth, Miami, have shown a little bit of sign of stability lately. But the Class B and Class C properties and anything with age on it is facing real headwinds. And right now today, there's $175 million, 175 million square feet of sublease space available in the market. Also interesting to note that starts are down dramatically, which is part of the recovery process, right? When a market gets sideways like office has, it doesn't make sense to build new property. So slowly over time, or sometimes quickly, that excess inventory gets absorbed. The market begins to stabilize. And starts this year in the office world will be about 17 million square feet. The average starts on an annual basis over the last 10 years have been 44 million square feet.
Wow. Okay.
So I didn't do the math, but that's a 60% decline, something in that range.
Yeah.
So you're seeing the market, the development market react to what's happening with office today and really, pull back in terms of building new space. Another interesting dynamic in the office market is that the large companies, more than 10,000 employees, are the ones that are downsizing and abandoning office space.
Okay. I was just about to ask you a question that I was thinking maybe it'd be the reverse.
It's actually the companies with less than 1,000 employees are the ones that are expanding their office space, the amount of office space they're absorbing. They're growing, they're adding people, probably have, this is an opinion or not even an opinion, a thought, but they probably have a little bit different cultures, and so people are more likely to give in to the request that they come and work from the office. But so it's an interesting market. There are some people that are saying that they're seeing early signs of recovery. Leasing activity is up a little bit. And there are some people out there that really focus on the office market that think you're starting to see the very, very beginning of the stabilization process. But unlike multifamily, where it's gaining momentum, office is a year and a half to maybe 2 years behind where multifamily is, just as a point of reference. So it may be entering the bottoming cycle, whereas multifamily is in the heart of the bottoming cycle. That's where that year to year and a half gap between where they are in their cycles probably exists.
Okay. I have not even an opinion, but a thought, so office is in a continued challenging environment, and you've got Class A structures doing okay in major markets. And my thinking was, because they're typically really beautiful offices. You go to these big, fancy, nice places at a big tech company, for example, they have coffee and, shopping around and all that kind of stuff. And so it's attractive for people to go into. So these bigger companies are paying top dollar for these places. Class B and C not doing so well because they're older. People are less likely to want to go. But what you said was these larger companies are the ones that are actually shedding office space, and smaller companies are growing office space. So I'm just fascinated by why that might be, but also why the peak might be coming, let's say, in the next 12 to 18 months. And I'm just fascinated because one storyline out there is that Gen Z workers want to be in the office because they want that mentorship and camaraderie and things like that millennials and older already got. So they're fine working at home because they're mid-career. But Gen Z wants to be in the office, so they're actually more excited to be back in. So I don't know. There's so many different storylines I'm interested in. Yeah,
it's a confusing market. I mean, quite frankly, it's a market I'm not interested in. Because there are 4 other sectors in the real estate world where sort of where they are and where they're likely to be going is more clear.
Right.
So I think there's probably going to be an opportunity as this shakes out. I think it's early. I think you're a year to 2 years away to pick up some Class B property, at a good value. But as there is in every market, when this kind of thing happens, there's a dislocation between what buyers are willing to pay and sellers are willing to take. And
Right.
the market has not worked out that dislocation yet. So sellers are still wanting, prices based on an earlier time, and buyers aren't willing to pay that. So you're seeing transaction volume, decline, month over month. The only transaction, not the only, but I mean, you've got some people that get backed in a corner, that from a debt standpoint where they've got maturities coming at them and they can't refinance because they're running at 80% occupancy, that are forced to sell, in creative sort of deal structures. But the normal transactions between a buyer and seller just aren't happening because there's a real dislocation in the office market. There'll be a point where it'll break, and you'll be able to pick up a Class B or Class C, property in the right market at a good value that makes economic sense, and have an opportunity to really see the value of that property grow above what you paid for it over time. But I just don't think we're there yet.
Yeah. The work from home debate is still unsettled, so we'll see.
Yeah. It's, but that's the one that suffered the most direct, from a real estate standpoint, the most direct long-term impact. Was the office market, and it's still trying to figure out, where it's going.
Yeah, it makes sense.
I touched on hospitality only really briefly. I didn't dig deep. Not a lot of data from me there. But if you look at it relative to COVID, it was a very severe short-term impact. During COVID, during the lockdowns, it was a very severe impact on the hotel industry. But if you were able to survive that, it rebounded pretty quickly. And it rebounded in a positive way because I think we were all so affected by our inability to travel and be mobile during COVID that people have done more of that post-COVID.
Yes, right.
And the hospitality industry has benefited from that. When I say hospitality, I didn't look at restaurants and that type of thing. I'm really talking about hotels. Occupancy today on average in the hotel industry is about 63%, about 2.5 points below the pre-COVID occupancy. But rates and revenue per room are above pre-COVID levels. So what you're seeing is a return to solid profitability, even though occupancy is down just a little bit. And so the hospitality market, is pretty stable, actually. I didn't look a lot at supply and demand and development because it's a asset class a lot of people don't look at as an investment. And it has a very intense operating dynamic, right? You think about the stratas of real estate. If you're in the grocery anchored shopping center business, your anchor tenant has a 20 or 30-year lease. If you go to the hospitality industry at the other end of the spectrum, your tenant base turns over every night.
Right.
And which is also why you see generally higher cap rates in the hospitality industry, because the cap rates are a reflection of the likelihood of the continuance of the cash flow stream. And when you literally turn your customers over every night, it's more volatile than a 20-year lease with Kroger.
Yeah, that makes sense.
And so that's a whole different conversation. But
Yeah.
But hospitality is fared pretty well and seems to be kind of leg spread wide. And again, occupancy's a little off. That's probably due to some of the new supply that's come into the market. But overall profitability solid across the industry and looks pretty good. I saved the one selfishly, other than the small bay industrial storage, I saved for last. We've talked a lot about it. Don't need to beat it to death, but it's stabilizing. It's absolutely stabilizing. And it suffered a very interesting roller coaster ride because of COVID. We've talked about this before. The use of storage exploded when COVID hit. For obvious reasons. People were cleaning out bedrooms to make offices out of them so they could work from home, or they were just bored and they were at home and they were cleaning out the garage and the attic and, whatever. Occupancy went well north of 96%, some markets 97, 98. That combined with low interest rates spurred a ton of development that started in 2021 into 2022. The headwinds started to show up in sort of mid-2023 as there was downward pressure on rates because of the oversupply. And we had a 28-month period where year over year rates, street rates, advertised rates declined. If you bought a facility, in 2022, late 21, 22, what you had happen to you was you saw cap rates expand, which meant the value of the property went down, and you saw your revenue decline month over month over month over month for 28 months in a row. And if you bought a property in 21 or 22, you probably are sitting right now at about a 30% decline in the overall value of that property today.
Gosh.
If you were to sell it. However, the market is stabilizing. Street rates have stabilized. They're starting to move upward. And as it does in almost all markets, your development has slowed dramatically. Today, the pipeline inventory is about 2.8% of current stock. So it's when we started talking about this a year ago, on average, it was about 3.2%. So you've seen it decline from 3.2% of current stock to about 2.8%. And the projections that Yardi and the people in the industry are doing show new supply at about 2.3% in 26, 2% in 27, and then further decreases, but they're far enough out, they're not really willing to put a number on them from 2028 through 2030. So you're seeing a fairly consistent, I wouldn't say steep, but steady decline in development activity as rates begin to stabilize and that oversupply that came out of COVID gets absorbed. And if you're developing like we do, I certainly care what rates are, and I certainly care what occupancy numbers are when we're leasing up a facility. But I don't give a darn about cap rates, and I don't really care. It takes 4 years to lease up a storage facility.
Yeah. Right.
So if we break ground today, that facility is not going to be stabilized and leased up for 4 years. And so the continued decline in development activity, the strengthening of the rates all tell me that in 4 years, we're going to be sitting in a pretty good place. Cap rates will compress again. Yeah. And I think the values will be, attractive. If you, like I said, if you're buying something today, a little different story, or if you bought it 2 years ago, but as a developer, that 4 year time frame, and what happens to us if the market's a little slow is it's not that it doesn't lease up, it just takes us 4.5 years or 5 years to get to stabilization where we can sell the property. And the good news is, although that does absorb a little bit of capital to carry a property a little bit longer than you may have projected, it's not a significant enough capital to really materially impact the returns. It'll lower the returns a little bit if we have to hold a property for 5 years instead of 4 years. But generally speaking, that drag on cash flow that a little bit slower lease up causes doesn't have a profound impact on the terminal returns to investors. So, the storage market is stabilizing, and we're seeing that happen right before our eyes in 2025, and I think 26 through 30 look like a really good time frame to be in the storage business.
From a developer perspective as well as an investor perspective, right? So if you're speaking to investors and want to summarize all these themes where you've got multifamily, retail, industrial, office, hospitality, and storage, and those are most of which are either in the stable or gathering momentum kind of phase. This is a good time to be an investor. Is that right? I mean, what's your overall take to if you were to talk to investors right now?
I think it's an excellent time to be an investor. I think the timing, if you're buying an existing property, is a little more critical. And so that varies a little bit between the sectors in terms of where you are in the timing. If you're developing, I'm pretty comfortable. I think multifamily is attractive. I think it's a great space to be in. I think self-storage is attractive. I think office, too risky right now. I'm not ready for it. I think industrial sitting in a good place, kind of right behind, the multifamily and storage. And I think retail didn't see the volatility up and down. So I think it's a solid place to invest. I don't think you're going to see the same returns that you'll see from multifamily and storage. But I think it's a solid place to invest if that's, and they're often, particularly if you're buying an existing property, often very attractive from an income standpoint. If you're an income-oriented investor, it's a product that provides attractive cash-on-cash returns and has some real intermediate to long-term stability in that cash flow stream.
So I hear good news. I hear pretty green lights.
Yeah.
So this is good. Okay.
We're feeling good about what's happening across the market, and excited to see our brethren in the multifamily world get up from from their knees. They got beat up a little bit over the last few years,
Yes. Well, the future is uncertain, but it seems really promising, and hopefully, markets are kind of stabilizing right now. I know at least in the equity markets, things are kind of up and down, but I hear good things. People are excited about the back half of the year, so hopefully that's the case in real estate.
Yeah,
for sure.
I think 2025 is a year where everything kind of gets its legs under it and is in the starting blocks, and I think you'll see it. Assuming there's some reduction in interest rates, and assuming something doesn't happen on the geopolitical stage that you don't see coming, I think now is a great time to be looking at opportunities and starting to deploy capital and plan on, like we talked about, I think in last week or the week before, sort of spreading that capital over a period of time. You'll never hit the bottom exactly, but if you're invested in storage and multifamily and you do it consistently over the next 2 years across multiple deals, I think you've hit the time about as well as you could.
I love that. Dollar cost averaging, as they say.
Yeah.
So,
yeah.
Okay. Well, I don't know about you guys, but I'm going to follow the smart money of Paul Bennett and see where we can go from here. So, Paul, I always leave our conversations so encouraged, and this is not an exception. So thank you so much for your wisdom. I know you spent a long time poring over this data to help us out, us novices, us peons, listening to you kind of go through all these things. So appreciate your outlook and your perspective as always, and we'll see you next time.
It's always fun, buddy. Thanks.
All right, man. We'll see you.
Take care.